Hello, this is Professor Karen Kent. Today we are going to be talking about Chapter 13. I'm going to be going through the examples that I posted on the Blackboard. The examples are, you can download these examples before you go through this recording, or you could just follow the examples while we go through this recording. We're going to be talking about Chapter 13. Chapter 13 is non-financial and current liabilities. So in this chapter, we are only going to be talking about current liabilities. Later on in the course, we will be dealing with the long-term liabilities, but today's chapter is only current liabilities. So when we are talking about non-financial liabilities, just the word itself, non-financial liabilities. What is a non-financial liability? What is a definition of non-financial liability? Non-financial liabilities are not payable in cash. Therefore, they are measured a different way. Therefore, they are measured different ways. So I'm going to give you some examples. So when we think about non-financial liability, we think of the first one that comes into my mind is unearned revenue. Unearned revenue is a liability. We got some money, the company received some money in advance. Now it's time for the company to provide them the services. So it's measured with services. The second one that comes into my mind will be a product warranty, which we will be dealing with later on in this chapter. So what is a product warranty? Is a warranty that you get it with the product. Means the company stand behind their product. If something happens, they will fix it or they'll replace it. Another one is that also we're going to be dealing with it later on in this chapter. I'm just going to mention it here briefly, but we will go through it in details later on. So it's an asset to retirement obligation. It's an obligation that we have an obligation at the time the asset retires. So non-financial liabilities are not payable in cash. Therefore, they are measured different in a different way. Now we discuss non-financial liabilities. Then we go to a financial liability. Financial liabilities are opposite of non-financial liabilities. In other words, financial liabilities, I spelled this wrong, so it's financial liability. So the financial liability is an obligation. Let me write it is a obligation to deliver cash or other financial assets. Asset to another entity. What do we mean by that? If you think about it, a perfect example will be your accounts payable. We purchase something means we purchase supplies, you debit the supplies, credit your accounts payable. So now when we are going to, accounts payable is a creditor, so we have to pay it. When we pay it, we debit the accounts payable, credit the cash. Just the example, this accounts payable is a financial liability, is an obligation to deliver cash. So when we pay for it, we have to deliver them cash. Now, another example that comes into my mind is salaries payable. Salaries payable, that's the second one. This is the accrued wages that you owe to your staff or your workers. When it's time to pay for it, you debit the salaries payable, credit the cash account, so it'll be paid with the cash. There's so many of them. You could there's a dividend payable. Another example will be your rent payable. just to mention some few of them. You can go through the chapter. There's so many of them listed. So the ones comes into my mind at this point is accounts payable, salaries payable, dividend payable, vacation payable, accrued liabilities, any type of liability that will be paid with a cash or with another asset. Now, the next one that comes into my mind is for the financial liability is a notes payable, notes payable. So we're only going to be dealing with the short-term notes payable. We're not going to be dealing with the long-term notes payable. So when we talk about notes payable, there's two type of notes. First one is the interest-bearing note, and the second one is interest-bearing note, and then the next one is zero interest-bearing note. So there's two type. It's the word itself. This one, it's interest bearing, and this is a zero interest bearing. As an accountant, we know there's nothing zero interest bearing notes. There's a interest is built in. We just don't see it. So we're going to be talking about both of them, and that leads us to our first example. We're going to be talking about our first example is the notes payable example. When we're doing it, the first one we're dealing with is an interest-bearing note. If it's an interest-bearing note, the how to journalize if it's a note payable, which is a short term, and it's interest-bearing notes. In this example, is saying that the provincial bank agrees to lend 100,000 to Landscape Corporation on March 1st, 2020, and the company signs a 100,000 4 months 12% note maturing on July 1st, 2020. So we're doing what we are doing is we're doing a journal entry in the company's books. So that's what we are going to be doing, journal entries in the company books. So what we did is that we went to the bank and we signed an agreement. We borrowed some money. So at the time, when did we sign the note? We signed the note on March 1st. So March 1st, we are going to do an entry. So what we did, bank lends us money, so the cash is coming in. How much they gave us? They gave us up 100,000. Then we signed a note, so it's called a notes payable. In this case, it's only for 4 months. If it's a 4 months, it's a short-term notes payable. So it's 100,000. Now our year end is different from the notes, the retirement of the note. So then if our year end is different, we have to do a accrued entry for our interest. So how do we calculate interest? Our note payable was 100,000, and then our interest is 12%. We got the note on March 1st. We're recording the interest on June 3rd. From March to June, how many months are gone by? 4 months. So March, April, May, and June. 4 months are gone by. 4 divided by 12 should give us 4,000. So since we're not going to make the payment till July 1st, we have to record a accrued interest. How do we record an accrued interest? Debit the interest expense, credit your interest payable of 4,000. Then we have the next journal entry we have to record is at the time we have a payment. The note matures on July 1st. So on July 1st, that's when we make a payment to the bank. Now it's time to pay the bank. How much we're going to give them? We're going to give them 100,000. So then, we're not going to give them 104,000. How do we get the, okay, let me erase that. So we have a notes payable. Let's do the notes payable first. Our notes payable was 100,000. Now we pay off that liability. We also have an accrued interest. So we have to clear that accrued interest payable of 4,000. Now we're going to give the bank 104,000. So 100,000 that we borrowed, 4,000 that was the interest for the 4 months. So we make a payment of 104,000. So that's an interest bearing notes payable. Now our next one that we are going to be talking about is zero interest bearing note. So there's nothing, there's no bank will give you money as a zero interest bearing note. So it's just you don't see it. So how do we know how much is the interest? Before we go further in it, we have a, there's two things in this case is the Landscape Corporation issues a 100,000 4-month zero interest bearing notes payable to the provincial bank on March 1st. The present value of the note and the cash received is not. So the present value of the note is 96,154, and the future value of the bond is, of the note is 100,000. Difference between those two is your interest that we are going to be making a payment to the bank. So there's nowhere it said that there's no zero interest bearing note. We know that when somebody tells you zero interest bearing note, the interest is going to be built in. So let's see what is the difference between how do we do the journal entries different from these interest bearing notes payable. So when at the time you sign a note, we got what cash did we get? 96,154. Our notes payable is 96,154. So now I posted in another on your blackboard how now if you have in this case if you look at it, we are not given a interest rate. How do we calculate the interest rate? If you have if you don't know how to use a finance calculator, I already posted a document containing BA2 plus how to use a calculator, a BA2 plus, but I'm going to show you here. So if you are having a hard time using a calculator, go back to BA2 plus document and learn how to use a calculator. You do need to use a calculator in this course to work out some of the questions. So if we were to use a calculator, we have to calculate the interest because the interest rate is not given in this question. Even though we know the total interest will be 3,846. So if we know that the present value of the note is 96,154, we know our N is 4 divided by 12. You know your payment is going to be at 0 because we're not making a payment till the end. And we have a future value of the note, which is 100,000. That's what we're going to pay them after the 4 months. You're going to say compute your IY. It should come back with a 12%. Go ahead and work it out. You should get a 12%. So now if the interest rate is 12%, we have to record, my second entry is to record an accrued interest on July 31st. So we know our note was worth 96,154. We multiply by 12%. Again, we sign the note on March 1st, and then we are doing a journal entry on June 30th, which is 4 months are gone by. Multiply by 4 divided by 12 will give me 3846. If now how do we record this this transaction? I'm going to erase this so I could record a transaction. So debit will be interest expense, which will be 3846. My credit will be notes payable of 3846. Now you see the difference when if it's an interest bearing note, we charge it to the notes payable account, but if it's a zero interest bearing note, we charge to the notes payable account. Now it's the time to make a payment for your note. How are we going to make a payment for your note? You're going to have a notes payable, which will be 100,000, and then your cash will be 100,000. How did we get the 100,000? If you have a T, let's do a little T account and post all our journal entries. So my first journal entries, I will have 96,154. My second journal entry, I have 3846. If I add them both together, they will be 100,000. Now it's time to pay for that. Notes payable, we're going to debit the notes payable and credit the cash. So there is a difference between the interest bearing note and a non-interest bearing note. The difference will be at the time we do accrued interest and at the time we do a note payment, repayment. If you still haven't issued, this example is right from your book. Most of the examples are taken from the book, and I'm just going through all the examples. I cannot go all the examples, but I'm going to do the most important one that I think it is important for us to go through the examples as a lecture. Now, our next topic is refinancing of a short-term debt. Why do we need to refinance our short-term debt? If you think about a short-term debt, where does that short-term sits? It sits in our current liabilities. So if you're going to go apply, going to go get a new loan, they're going to look at your balance sheet and they're going to work out some ratios. The banks normally look at the current ratio. The current ratio is calculated using the current asset over current liabilities. So what we wanted to do is we wanted to lower our current liability as a company. They want to lower their current liability so they can go get a new loan or they can improve their ratings. So that's why most companies want to refinance their short-term debt. What they want to do is they wanted to move some of the short-term debt into a long-term debt to improve their statements, to improve their ratios. So we're going to be learning both how to deal with the refinancing of short-term debt and long-term debt. So I need the space, so I'm gonna just erase this area. So we're going to be talking about short-term refinancing of a short-term debt. So we're going to go through this example and we're going to explain it. What do we mean by refinancing the short-term debt? How we're going to disclose it? How we're going to present it on our financial statements? Now, in this case, assume that Montana Winery has a 3 million short-term debt. So we know that when you have a balance sheet, you have a current liabilities and we have a long-term liabilities. So they are saying that in this case they have 3 million in the short-term liability. We're just going to read the question and see what the question is telling us. And then it says of a short-term debt at the beginning date, at a reporting date, I have it twice, so we don't need those two. At the reporting date, the company issues 2 million long-term debt after the balance sheet date, but before the financial statement date. Those two are different. So our balance sheet, if you think about a balance sheet date, balance sheet year, if the company's year end is December 31st, let's say it's 2019, that's their balance sheet date. For companies to process their adjusting entry at the accrual entry at the end of the year, it takes them a couple of months to do their adjusting entries, and then they produce their financial statement. The date of their financial statements are not the date, when they post the financial statement on their website is different. So they have a couple months normally to do the adjusting entries before they can release their financial statements. So what they did is, what this company, the winery company, is doing is, what they have a 3 million debt. What they wanted to do is, they don't want the 3 million debt under current liability. They wanted to move some of the debt into their long-term debt. So what they did is, after the balance sheet date, they looked at their balance sheet. They saying, oh, we should improve our current ratio. How we're going to do is, we're going to go get a 2 million long-term debt to pay off our current liability. So the next question that comes into that we have to deal with it. This company, if this company is ASPE company, means they're following following ASPE standards. If they're following the ASPE standards, what they have a short-term, they have a current liabilities of 3 million, and they have a long-term liability that was zero. So what they want, they say, how should Montalban winery classify its short-term debt if it follows ASPE, assuming its uses the proceeds from the long-term debt to liquidate 2 million of the short-term liability. So what they did is they issued a long-term liability and they pay the short-term liability. Now they have their short-term debt, which is going to be worth 1 million, and they have a 2 million worth of their long-term debt. So what they did is they went and got a new loan, which is the 2 million loan. They paid off the with short-term liability, and now they have a long-term note. So even though altogether their total liability is 3 million, but they improved their current ratio by issuing a new liability, which is a long-term liability. So now, since this was done before the financial statement was issued, so they are going to, on their financial statement, they're going to show a current liability of 1 million. They're going to show a long-term liability of 2 million. Now, under ASPE, this is okay. Under the IFRS, they have a different standards. So what I wanted you guys to do is to, I think it was, if on your book, if you go to page 1312, it tells you how to deal with it, and we're going to deal with it here too. So now it's the same company. What they did is, how should Mont Avon Winery classify as short-term debt if it follows IFRS, assuming it uses the proceeds from the long-term debt to liquidate 2 million of the short-term liability. So they are doing the same thing. What happens is they had a current liability at the balance sheet date, which was 3 million, and their long-term liability was zero. If their long-term liability was zero, then now what they did is they issued a new long-term liability, which was 2 million. And what they wanted to do is they wanted to use that 2 million to pay off their short-term liability. So the question here is that how should they classify it? Now, under the IFRS, I'm going to read the note right from your book. It's saying IFRS, if the debt is due within 12 months. So if the debt is due within 12 months, it will be if the debt is due within 12 months, it will be recorded as a current liability, even though you made an agreement that you got the long-term debt for 2 million to pay off this liability. The IFRS standard are very what they want you to do is they don't want you to manipulate your financial statement. If you had a short-term liability, it will still be a short-term liability. It'll still be sitting as a current liability, even though you got a new loan to pay off this liability. That will be done in the following year. You cannot be done in the last year, even though the financial statements are not issued yet. So the page that I want to refer you to is page 1312. Under the IFRS standard, if anything is due within 12 months, it will be recorded under the current liability. If something is due within 12 months, it will be recorded as a current liability, even though you got a new loan to pay off this liability. That payment, for example, if our year end is December 31st, 2019, you will still have a current liability of 3 million, but when it comes to 2020, then you could pay off this short-term liability. And it is so then I want you to go through 1312 to see what is the difference. There's only one exception. So the exception is the only exception accepted for continuing to put this 2 million into a long term is if you had a current liability, now you want to transfer that liability into a long-term liability, it has to be an existing agreement. Means you have to have an existing agreement saying that I want to transfer some of the short term into a long term. It has to be existing agreement in place before you could before you're allowed to transfer this current liability into your long term liability. Otherwise, the rule says that if anything is due within 12 months or from the reporting date, it has to be reported as a current liability, not a long-term liability. So again, you could go to page 1312 if you need to discuss a little.